DEO is down over 20% just over the last 12 months, and we can see it right there trading at its 52-week low. So do we now have a golden opportunity to buy this very strong company for some massive gains over the next few years? We're going to analyze this company in detail, but we also want to take a look at why this company's share price continues to fall, looking at 4 different bearish indicators. And as always, we will take a look at the numbers. We want to see, is there growth coming out of this company over the last 10 years? Top line revenue analysis as well as the bottom line net income. We also want to understand the health of this company, their total cash versus their total debt, as they do pay a nice healthy dividend. And as always, we'll talk about the dividend safety, which looks impenetrable right now with a 99 very safe score, as well as the underlying supporting metrics. And we'll also understand whether or not the institutions continue to add this company into their own portfolio. And as always, we will run it through into the valuation model, getting to both our intrinsic value as well as our acceptable buy price, and focusing on our margin of safety, and understand whether or not Wall Street themselves see some nice upside over the next 12 months. Now, before we jump into any numbers, we first want to just take a look at, for those who maybe this could be a new company to analyze for their portfolio, essentially Diageo owns over 200 brands and there are sales in nearly 180 countries. Now, if you are someone who drinks, maybe these are products that you had heard of. Very famous, well known. We have Johnny Walker, we have Smirnoff, Guinness, Baileys. So again, this is a company that has some very well-known established brands, and as we can see, in fact, over 200 in nearly 180 countries. Now, as we just very quickly looked at, they are suffering over the last 12 months, and we will just take a very quick look at some of the reasons why this is happening and whether or not this could continue to happen over the next few years. Now, we already know that it is in a nasty downtrend, as we saw, down over 20% just over the last year. We'll also analyze it over the last 5 to 10 years, that it hasn't had some strong historical performance. And the main thing to note with this is 4 different factors as to why this company not only has been decreasing but could continue to decrease. As always, not just the bullishness scenarios, but we should also take into any bearish factors. First one then is that growth has stalled due to a weak environment in the US. One thing to note, it is the largest market for DEO, and we can see the analysts for the full year, which does end in June 2024, so we should have those annual reports soon, is that revenue growth is expected to be fairly flat. So one issue that we do note there. The second one is, if you would have heard of this, the GLP-1, the weight loss drug. So these are examples like Wegovy and Ozempic. Essentially, what this is looking to do is to reduce the desire for customers, not just on alcohol, but also fast foods, really unhealthy foods, processed foods, so they can lose weight. And this could ultimately end up being an issue for Diageo moving forward, as that will ultimately affect their top line revenue. If less and less consumers are buying alcohol, then as we saw, they do have some significant brands, and that could hit their top line. We have another issue, which is something that maybe you could leave a comment below, whether or not you see the drinking habits in the future reducing from what we see now. A lot of talk on social media about how the younger generation aren't drinking as much alcohol as maybe past generations, and this will obviously and ultimately affect these companies' numbers. Whether or not, though, you do believe this, let us know. It would be good to know what the community thinks in terms of the future, with drinking being something that is going to be as common as we saw in the past generations, or something that may be slowly phased out. There is a fourth and interesting point here, that investors just don't have that confidence in management that they previously had. As we did see in our previous analysis of this company, there was a profit warning that they did talk about how this company's numbers were going to be lower than anticipated, and therefore this isn't something that a lot of people are giving confidence, as we can see, to their newest CEO, Deborah Crew. So 4 points here just to consider when we are looking at these numbers. Not everything is just about the numbers. We should also, where possible, understand a little bit about what is driving these numbers positively or negatively. And what we can see here is, as we mentioned, over 20% reduction just over the last 12 months. If you've been a shareholder over the last 5 years, a very similar poor performance. But if you have been investing over the longer term, nothing really to brag about here, plus 6%. Yes, if you reinvest dividends, it would be slightly higher, but as we can see, very, very poor return. And if you want to see their all-time high, you would have to go back nearly 3 years, around $220. So as we mentioned, right there at their 52-week low, we have one buy rating from Seeking Alpha, a 4 out of 5. However, both Wall Street and Quant do give this a hold. The yield on a trailing 12-month basis is just over that 3% level as well, and a forward P sits around 16.97. Bear in mind the S&P is around 22, but we'll have a quick look to see what others in this sector currently trade for on that same valuation metric. So let's jump into some numbers then. So top line revenue, what we ideally like to see at a minimum 3 to 7%. Remember, that is just to factor in at a base case level of inflation. So 17.5 billion in June 2014, 21.7 in their latest annual accounts for 2023. So very minimal growth, and in fact, interestingly, when we do look at it on a graphical basis, we can see very minimal movement year on year, something that we should consider when we are looking at our valuation metrics later on in the episode. In terms of the bottom line, what kind of story can we see there? Is there any growth? Well, 3.8 billion in 2014, 4.7 billion in that latest annual accounts. So again, very similar to the top line. Two things to note: minimal movement over the last 10 years, but also a lot of inconsistency. Granted, we can justify that drop in 2020 to COVID, but other than that, the movement hasn't seen a lot of growth. So again, do factor this into your investment thesis, and if you are happy to add this into your portfolio, then we will discuss the margin of safety as well later on. In terms of a quick health check, total cash versus total debt, 1.1 billion in 2014, 1.5 in their latest quarterly report. So their cash, again, very similar to the theme of this company, DEO, a lot of inconsistency and relatively little movement. But one thing to note, that this number on its own doesn't mean anything. So let's take a look and see in comparison to their total debt. Remember, both numerically and directionally where that's heading. 16.3 billion in 2014, 22.3 in their latest quarterly report. So whilst their cash position hasn't moved that much, their total debt over the longer period has increased significantly. So again, this will be very interesting when we do come analyze that dividend safety score. Even though it is 99, it will be interesting to see the underlying supporting metrics. So the first thing we want to do is take a look at the valuation grade. We get a C-, and now some of the drivers behind this: P on a non-GAAP basis, just under 17, sector median around 17.4, so it's only trading at a negative 2%, or essentially a 2% discount. When we look at other methods though, we do see very poor D across the board, whether it's a price to sales or a price to book, and the same can be said when we are looking at the other valuation methods, whether or not you want to use these or incorporate them. Overall though, we can see a C- grade. We then draw your attention to the growth grade. Now they get a D-, no real surprises given that their share price a few months ago did drop double digits due to the fact of that profit warning. And with that D-, the year-on-year revenue growth, 7.4%, better than the sector median of 2.56. Forward looking, although it has dropped down to 4%, pretty much in line with the sector median, although very marginally higher. And when we look at the other growth metrics, one that we like to always draw your attention to, the earnings per share over the next 3 to 5 years on average is only expected to increase by 1.84%. We can clearly see that others in the sector a lot better, high single digit, so that is very disappointing again. And therefore, as we can see with all of these different metrics for the growth aspect, they do get a D-. When we then draw your attention to the profitability grade, they get an A, which is very good, 60% in terms of their gross profit margin, so a lot better than the sector median. In terms of the net income, 20%, again a lot better than the sector median. So they have really nailed this profitability aspect of the business. Even their cash from operations looking very strong and healthy. 4.53 million versus the 800 million of the sector, but we can see where they do lack is definitely in that growth perspective. So a quick conclusion for this part of the analysis: a 1 buy rating with a double hold, a C- on valuation, a D- on growth, with an A on profitability. Now then we take a very quick look at how they compare against others in the industry. What we notice here: Constellation Brands, Pernod Ricard, Brown-Forman Corporation, as well as a few others. That DEO over the last 12 months, including reinvesting those dividends, are actually one of the best performing. So very interesting to note that the industry as a whole has taken a massive hit. So a lot of those bearish indicators that we discussed earlier on could be the general theme of the whole industry. In fact, when we expand this to over the last 5 years, we do see it as one of the middle performing, again negative 13%, with only 2 of them returning positive over the time period. When we extend it over the last 10 years, again, whilst it is positive, as a whole, this industry has performed very, very poor, although we do know MGPI up 911%. So bear that in mind, its historical performance has been very, very poor, but as always, past performance is not an indicator of the future performance. Now, there should be no surprises here, but we do like to keep things very consistent on this channel. In comparison to the S&P, which is up over 23%, we do know DEO down 20% over the same period. Over the last 5 years, up 86%, DEO down 14%. Over the last 10 years, we can clearly see the S&P is the much better bet, up 173%. Now, do factor in, again, just because they have performed strongly over the last 10 years, it doesn't necessarily mean the S&P 500 will outperform DEO again, but it is interesting just to note how much of a gap it has been over this period. Now, when we take a look at institutional ownership, around 9%, 700 million worth of sales by these institutions over the last 12 months, with more buys nearly double, in fact, at 1.29 billion, and we can clearly see over the more recent quarter a lot more buying than these institutions. The same to be said for the previous quarter. So over the last 12 months and in the more recent quarter, institutions are buying, but important to understand we should always do our own due diligence, not just copy what they do. Now, we have just released our latest free weekly article. If you do want to get access to this or any others, all completely free, do click on that pinned comment below and you can start reading straight away. If you want to know the websites and resources we use, for example, that is all in this article here. But we also have other articles where we do look at some high quality undervalued dividend stocks as well. So let's jump into the dividend safety. We have a score of 99, very safe. In fact, the highest score obtainable. Market cap just under 74 billion. And in fact, just at the beginning of this year, it was reaffirmed that their dividend is very safe, with a dividend cut looking highly unlikely. In terms of the last recession, for those who do see one coming, they increased the dividend during the 07-09 Great Recession. We also note plus 5% sales, well above the average of the S&P at negative 12, although they only marginally outperform the S&P, negative 51 versus the negative 55. Now, the last full year, nice increase, 5% at a minimum. It is beating that 4% inflationary target that we always aim for. 4% over the last 5 years, so they're giving you an increase over the last 5 years in line with inflation. Over the last 20 years, around 6%. Positive to note here, it is very consistent in their dividend increases year on year, and they are officially a dividend aristocrat. They have increased those dividends for the last 25 years. Now, in terms of dividend yield theory, as always, stating a company is undervalued when the current yield sits above the 5-year average. Our sign or severe sign of undervaluation here. In fact, this yield is the highest it has been over the last 5 years. And on the forward P, again, 16.8, lower than the 5-year average of 22.7. And also our third undervaluation signal below the consumer staples sector PE. Now, do factor in that we're not looking at any of these models in isolation, and we will conclude towards the end of the episode. Free cash flow payout then, below 70% is always what we look for if we want to be industry specific for consumer staples. Personally, below 60%, that does give me faith that management can offer those double-digit dividend increases. What we know here, however, 2023, 98%, that is a red flag indicator. They've paid out pretty much as they generated in free cash flows straight out as dividends. So do bear that in mind, although we do know it is anticipated to decrease into 2024 at under 80%. A little bit too high in my opinion. Free cash flow per share, as always, what we're interested in is companies that increase their free cash flows year on year, and they are very consistent. What we do know, whilst it has nearly doubled over the last 10 years, very inconsistent. In fact, it has been falling from 2021, although a large increase is anticipated into 2024. In terms of the sales growth, well, we did run through this, but we can now clearly see the percentage increases. The last 3 years looking very nice and healthy, but again, you can see 3 of the last 10 years have been negative. We also have a low year of 2018. So do bear in mind the inconsistencies over the longer term. And when we look at these shares outstanding, we do note they have been doing some share buybacks, returning that excess cash, but very, very inconsistent. Don't expect this every single year. In terms of looking at the ROIC, as always, 10% or more, giving us faith management can effectively allocate their capital. Plus 12% for consumer staples, pretty much consistently above that, so no worries there. 17% on a trailing 12-month basis, so that does look fairly healthy. And in terms of the operating margin, above that 16%, pretty consistent, which is always a good sign. Not just above that 16%, but consistently around the high 20s, low 30s, 30% on a trailing 12 months, so a positive sign. And in terms of the free cash flow margin, above 7%, they have hit that every single year. So again, margins don't seem to be a worry with this company. In fact, when we did look at the profitability grade, they were sitting at an A, so we did already take a quick look. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Now we focus on below 4 for consumer staples, remembering these are the number of years it would take the company to pay off all of that debt net of cash on hand. And this correlates to both dividend safety, balance sheet strength. So 2.61 is positive for the last 2 years. although it is anticipated to increase into 2024, and with their dividend payout being very high in the 98%, that is a little bit of a worry for me in terms of looking at this company. So there are some bearish flings to think about in this episode, not just what we looked at the beginning, but also in terms of this company, the amount they're paying out in dividends, and the increasing total debt level. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now let's jump into the first model. We have the multiples valuation model, companies in a similar sector and size, average P multiplied by that of DEO, and we see here an undervaluation signal, although it isn't too far off the current market value, so we would say it is roughly reasonably valued based on this first model. But as always, we don't look at any of these models in isolation. We then look at the dividend discount model, as we saw around 4.15% average over the last few years. In terms of the growth rate moving forwards, we have gone a little bit more optimistic, pretty much higher than the average, although lower than the more recent. This does give us an intrinsic value showing undervaluation 161 versus that market price, which is right there towards their 52-week low. We then move on to the DCF model with the free cash flow year on year. Average growth rate just under 6%. Forward looking, as we saw earlier, they are anticipating that free cash flow to increase drastically. So we have gone lower than anticipated from the market analysts as well as management at 11%. Based on this, with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and again, similar to the first model, we do have an undervaluation signal, but it isn't too far off the market value, so you could argue reasonable valuation. So the intrinsic value in today's episode is the average of these three models, and don't forget you can grab a copy of this model to run your own numbers through, whether it's for this company, others in your portfolio, or those in your watch list. So an intrinsic value of $147. We do tend to look at a margin of safety starting point at 10% and execute on that if it meets our three criteria: wide moat, strong financial metrics, and good forward-looking data. Now what that means for DEO is that right now it does trade at around a 10% MOS level based on our estimates and judgments. Now for me personally, there are a lot of red flag indicators across this, a lot of bearish indicators as well that did make sense when you think about it. But when we take a look at Wall Street as well, they do see upside of $155, 16% implied in fact over the next year, and it is higher than our intrinsic value. So as always, do let us know your thoughts. Was there anything that maybe you disagreed with when we were running through this video? Do you think that maybe there aren't that many bearish indicators, or do you also agree that there are a lot of red flags with this company and maybe it isn't one to own, or maybe you do see it as more of a value play? As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts, and we'll see you all on the next one.